Thank you for checking out the Municipal Market Update for the week of March 1st, 2021. My name is Adam Bauer, and I serve as CEO and President of Film and Roll-Up & Associates. Film and Roll-Up & Associates is a municipal advisor to government. Well, the municipal market has had a lot of activity, and we probably had the most exciting MMUs in recent months. It was so exciting, we actually had to do an MMU updated the day after we recorded the last one. We saw some real trends in the 10-year treasury or treasuries in general, and we thought it was important to get updated information back out. So for the first time ever, there was an MMU updated in between MMU recordings. So for those of you who have checked that out, thank you for checking that out. And the trends that we thought we might see took place. So I'm very happy that we had done that updated version. You have not seen this chart from us, and part of our key there is getting cut off. But what this chart is representing is the annual change in inflation. And if you look to the far left in those earlier years, you can see quite a bit of inflation. And we've all heard about Volcker and the things that went on in the early 1980s. But since that period of time, you've generally seen a lower trend in inflation. And so if you just look at that 25-year average, you're at 2.2. 15-year average is 2, finally 10-year average 1.7, and then 5-year average 1.5. So when we talk about how low interest rates have been, you might ask yourself, well, why would investors loan money for less than they have historically? This could be a key factor, is their inflation expectation is much lower than it has been historically. If you go back to the 50-year average and compare that to the 5-year average, the 5-year average is less than half what the 50-year average was. So generally, investors have seen lower inflation and maybe building in a lower expectation of this. But I think today, the presentation is a lot about investors' expectations going forward, and there may be a shift here. So first thing I think we should talk about is in August of 2020, the FOMC chair talked a bit about how they were going to look, how the Fed was going to look at inflation going forward. And so there's been this 2% inflation target. But what they were focused on was average inflation targeting. So instead of looking at the 2% as a maximum and saying, if we get to 2%, we must adjust, they are now saying, if inflation has been below 2%, then for some time, following periods where it's been run below their 2% target, they may allow inflation to run higher than that. So I think investors were for a large number of years saying our kind of maximum inflation that we would expect is 2%. And now they might look up and say, well, since we've had 1.5 for 5 years, in theory, the Fed might allow us to have 2.5% inflation for 5 years to bring that 10-year average back into the 2% range. So they may be building in more inflation expectations than they have historically. I think another factor is when you look at the amount of spending and the stimulus programs that have needed to go in place to assist our country and the world for dealing with the COVID-19 pandemic, there's a lot of spending. A lot of spending leads to inflation. And just last Friday, there was a 1.9 trillion stimulus bill passed through the House of Representatives, not through the Senate yet, but that certainly, if that goes through, that's another large amount of spending on top of what's already been passed. So potentially a lot of spending, inflationary issue. So on our next slide, you're probably getting the sense, I'm telling you rates are going up, but I haven't really showed you that yet. But what you're saying here as well, for months, you've told us when there's inflows into the municipal bond funds, that's demand. And if there's a lot of demand, that certainly should put pressure on interest rates. But I want to show you the next slide, that's supply. So supply, what we're seeing here, let me maybe move this picture out of the way. What we're seeing here is 2020 was a high volume year. And that's what that black dotted line is. What you can see is last week and projected for this week is our volume, the amount of bonds available in the primary market, is at or greater than a heavy year of 2021. So you have all these inflationary pressures, and now you have a lot of supply coming to market. And so that's that supply demand equation is kind of hitting that perfect point where we could be seeing interest rates go up, in part because of just a supply demand, not just because of inflationary expectations that I mentioned earlier. This chart, what we're showing here is the bar charts are the range of interest rates for each one of those maturities. Then the MMD we're looking at here. And I've showed a lot of months or weeks and months of doing this, is that red line has like scraped at the very bottom of those bar charts. And it did when I last did this presentation. You can see that red line has lifted up off of that. That's a shift higher in interest rates. What you're also probably noticing is the maturities years like 6 through 30 have lifted more than year 1, 2, 3, or 4, or 5. And so that yield curve is now a little bit steeper than it has been historically. Another sign that investors are preparing for some inflation. So now here is the chart I've shown you many times about the steepness of the yield curve and compared to some other benchmarks. So if you go back 5 years ago, that red line, you can see that as investors loan money for longer, they want more yield for it. That black line represents 1 year ago, and you can see they weren't requiring that much return for longer term maturities. Then now 2021, you see how that bottom, the far left part of that chart has dropped down, and then the right of that chart has gone up. That is a steepening of the yield curve. So now this is a chart I showed you on the MMU updated, but it didn't have that red spike. All it had was the black line going up, and the red line had not tracked it yet. And what our concern was that if U.S. Treasuries had gone up as much as they were showing that they had, that municipals were likely to have pressure to move in the same direction. And that's why we posted the updated version of MMU. And what you see now since then is that trend, or that did take place. Now, the municipals were slow and they didn't start to go up as quickly as the US Treasury did, but then they made up for lost ground. They moved up much more quickly. And you can see that there with that red line trending upward toward the 10-year Treasury. For both these lines, we focus on the 10-year maturity. So you've already seen this page. I told you you're going to see it again. And this is our inflationary chart and shows what's taken place over the last 50 years. With those inflationary trends that we're seeing, or potentially triggers for inflation, it could be that investors are now saying they're going to want more yield on their bonds. One of the things that's said about fixed rate bonds is inflation is the enemy of a fixed rate bond, because you have an interest rate, a coupon that you're going to get. And anytime inflation goes up against that, it erodes the spending dollars that you have from that. So it'll be interesting to watch. We are in an interesting time. The markets are pivoting. We don't know quite when we're going to get to a point of a new equilibrium. There's some signs that we did, because 10-year Treasury went up to north of 1.5 on Friday, and now has come back down and is hanging out in the lower 1.4 range. But we'll continue to monitor that and provide the updates as they come along. Our economic calendar ahead of us. These are all items that you should be watching in the municipal market if you're an issuer. And if one of these items comes in unexpected, then we certainly could see a change and could see an adjustment in rates. Following our last slide, just want to highlight our film and rollout team here. These are all registered municipal advisors. We encourage you to reach out to any one of them for more details on things I talked about, or just any general questions. This is a team that's available for you. But I thank you for your time and look forward to talking with you again in 2 weeks.